Good morning, everyone. A very warm welcome to this MBS webinar on the Global Economic and Financial Stability Outlook. I'm Yogesh Khatri. I'll be moderating this session. And by brief way of introduction, I'm a professor of practice at Nanyang Business School, among other things. And among other things, I'm an IMF retiree as well. So to say it's been a tough year would be a bit of an epic understatement. You're all more than familiar with the tragic loss of lives, the impacts on the most vulnerable, the economic costs of the pandemic. And despite some recent developments, I think it's no exaggeration to say we face unprecedented uncertainty about the outlook in the period ahead. So we basically don't have a template for this. So we're very lucky and grateful to have two of our brightest and best IMFers in the region here today to present on the IMF's view of the outlook, drawing on the World Economic Outlook Report and the Global Financial Stability Report, respectively. You have their bios in front of you, so I'll be very brief in terms of my introduction. Dr. Stephan Danniger will start, and he is the head of the IMF Singapore Training Institute, STI here in Singapore. And in his 2 decades at the IMF, he's had some of the prime positions, including heading teams on Germany, Japan, and I think the US. And Stephan has, published extensively in that time and holds a PhD from Columbia. Dr. Phakawa Jeasakul is also an IMF Resident Representative in Hong Kong, and he's responsible, among other things, for monitoring and assessing the macro financial developments in China, Hong Kong, SAR, and the broader Asian region. So Phakawa has been in the fund for about a decade, and he holds a PhD from UC Berkeley. So we're very lucky to have both these extremely well-informed speakers here today. In terms of the format for today, what we'll have is each speaker will present for 15 minutes, and then we'll have Q&A submitted to the Q&A tab, and I will, rather than read each question, what I'll try and do is clump the questions into kind of similar types of questions and present them to the speakers. So we should be done well within the 90 minutes. So without further ado, I'm going to pass over to Stephan. Thank you, Stephan.
Good morning. Thank you, Yogesh, for the invitation. I was wondering who you invited because you spoke of eminent people, so can't count myself as part of that group, but I'm quite pleased to be here and have that opportunity to speak about our global forecast. Many of you will know, but in case you don't know, the IMF publishes a set of forecasts 4 times a year. It's under the label of World Economic Outlook, also called WEO. And it's a result of a combination of a top-down and a bottom-up exercise across the organization. Top-down meaning there's a lot of modeling, conceptual thinking involved. Bottom-up is trying to get granular information country by country and adding it up. This forecast that we will discuss about today is also called our flagship. And I thought the term ship is quite fitting in the sense that we are globally really on the same boat. The discussion today is about where this boat that we all sit in is moving. So to some extent, bear with me if some of the broad brush statements seem very general. They are all rooted in quite deep, thorough micro foundations, micro-analysis. Not everything can be known, but we'll try to dig as deep as we can. But we are discussing the ship. We're discussing the big boat, the global economy, and the idea is to give you a sense of where we are and where we are sitting in our cabins inside the boat are moving. So this is where the analogy of the ship goes out the window, because some of us in the cabins are moving faster up, maybe not as deeply down as we've seen it. Others have a lot of stress still coming. So let me give you sort of 2 words outlooks of it to set the stage. Is the picture that we like to paint is that of a very, very deep recession, and you'll see it in a second, but followed only by a partial recovery in 2021. So we are not talking about a V-shaped quick up and down, even though on picture it may look like a V because the fall is so steep, but the recovery is only partial. So this is sort of like the one message to take away. And what we focused on, this is our 3rd forecast actually in the crisis, 1 in spring, in April, 1 in June, and this is the 3rd one. We're turning to this deep down turn and the damages it has for the medium-term outlook for the potential, which we think of it as a materializing in our 3 to 5 year outlook. So we'll get to that as well. A good forecast has risks. I'll spend a good deal talking about what the risks are, how we can quantify them. There is not one way on how to think through this, especially in a global setting. There's so many regional, sub-regional elements. Think of Latin America, very different background coming in than Asia, than Europe. But we have some common themes that I think will matter and that will decide all of those countries being pushed in one direction or another. So with this, let me jump right into, and I'm cautious of time. So I told Yogesh I have very few minutes, but I'll want to use them wisely. Okay, so this is a simple chart looking across the sectors in economy. So the letters from A to Z are, if you are familiar with economic sectors, the 1-digit classification will tell you A starts with agriculture, B with mining, quarry, and so on and so forth. So here we depict across those sectors, and the letters I explained at the bottom, where the biggest impact is. Why do we care about it? Because it's such an unusual recession that we haven't seen before. It's the red bars that we care about. These are GHI and the ones at the end. And these are the services sectors. So services in transportation, in retailing, wholesaling, accommodation. So these are the ones who collapsed, and they collapsed tremendously. Look at this, is a 16% decline year over year in those sectors. So that's the one element. If you want to build a forecast, we'll need to see where things are happening. You might notice that in this area, things have not looked so bad. This is the IT services sector. That is sort of like the ones that actually we belong to in a way that has not been affected. Construction is here just in case, industrial production is here, but we'll see that has come back quite phenomenally. Where has it come back most phenomenally? So we know that Q2, so April, May, June was, or is likely was hit the hardest. How well and how bad was our forecast, and where we're heading now? So what you see now is in blue, our forecast across all those countries, and how we got it right or wrong. So luckily, blue has been mostly correct because the reds are the surprises up, and the greens are the surprises up, and the reds are the surprises down. How much is it? Are these differences? Let's just first look at, and you'll be shocked. So you have here minus 40%, maybe minus 30 is the Q-on-Q annualized rate. So quarter-on-quarter GDP growth grows at a certain amount, and we think of it in an annualized rate. So we have to multiply it by 4. So you have a minus 25 to 30% on average across those countries. The US, during the global financial crisis, I looked it up early this morning, had a 9% deepest swing from one quarter to another. So we're talking about multiples, so dramatically large. So given that it is so much larger, we got it mostly right. But have to say that the greens are here, So the advanced economies did a little better than we thought. And the emerging economies, this is the Philippines, you see Malaysia, you see India, had it worse. So this is a second building block for our forecast. The third building block is we are in a recovery. And the third quarter is what happened this summer. And you can see it quite dramatically on the left-hand side. These are production and trade volumes. Manufacturing, for example, these are new orders. They have bounced back to levels where they were before. And I think, lo and behold, there has been also a shift in consumption due to a lot of fiscal stimulus. I'll get to that in a second. In the commodities area, meaning goods and services, goods areas and not the services. Services are also rebounding, and there is some opening up. But here the point is, so these are the month per countries over the summer, and 50 means that more than half of the surveyed companies or managers expect to expand as opposed to contract. So 50 is just even. So we've been quite below 50, meaning dramatically below that. As of April, it was like a vast majority of firms did not want to consider even hiring. Now it's about even. Big contraction, but not a large bounce back. That's what's to take away. And this is for business activity in the services sector. Okay, the third building block this was. Here we have sort of like a first hint at where we are on the longer term implications. Employment collapsed. So from 1 to 86, this is a 14% volume decline in employment. And well, by now, this is sort of like September-ish, we're still far below. And the longer this goes on, the more of a scarring there is. Of course, you would not be surprised that employment is linked to how much of workplace mobility has been allowed, meaning how much social distancing is still in place. And these Google Index, which you can look up, it's a way how we can measure people's mobility, whether they go to work or not, has improved, but it's still way below where it used to be. So there's still restrictions. Okay. So what's holding this recovery then back in Q3 now that we see the rebound? And it's this dramatic number here. So this is where we started out with cases, and we probably underestimated them. But then as of June, we should probably have globally a good handle of where things are. And it's just going up. Now, true, it went up because India was a case that pushed it up a lot. Also Latin America, these both have things in control, but where are the latest trends going up dramatically in the Euro area? This is this part, and the United States. And they are forebearers, in my view, what will happen on the ability to release the lockdown further. Basically, what we've seen is on the right-hand side is these are measures of restrictiveness, on stringency. There has been since May coming down, so an opening up, but it's difficult to see how that can go down further if you have these massive blocks entering again a new phase of infections increasing. So this is all sort of like the setting. I'm going to skip the inflation numbers. We can go back to them later if you're interested. So despite all this, shouldn't we have seen like even worse outcomes if you have a 30% GDP decline in one quarter and the fiscal stimulus was massive? You can see it here, 8% of GDP in numbers, and I wrote that down. Overall stimulus from fiscal measures has been $12 trillion US dollars. 6 in fiscal spending / reduction in taxes. So fiscal measures around 6 billion, and that's also in our baseline that has been announced, I should say, not billion, trillion. and it's been announced. So part of it has been already pushed out in the US, for example. You've seen a lot. And of course, the policy rate expectations have declined. So a lot of things setting the stage for this forecast. The stimulus helped contain spreads going up. Equity markets have held up because there's been enough support for firms to tie themselves over for the time being, for governments to refund themselves at a reasonable rate. So where does this leave us? So for the forecast, the real key considerations now is the uncertainty of the pervasiveness of the pandemic. And you've seen that chart just now with this exploding infection rates. So is that pervasive, meaning does it stay for long? That's sort of the one consideration you need to take into account and you need to take a stance on it. And the second one is what's the policy support going to look like? And partially that's going to be baked in because there have been announcements. Partially we might reach some limits there. So what is the assumption on the first part? So we have some fairly better momentum coming into this next forecast period. We assume as the baseline forecast that some form of social distancing will persist well into 2021. And if you look at it, it's really going to be phased out only by the end, fully phased out only by the end 2022. And there is simultaneous improvement of the resilience of the population in health through a vaccine coverage. So there is already an assumption about a vaccine. We can talk about the announcement today, yesterday, how that would affect the forecast. The second one is that the countermeasures will continue. So there's a massive stimulus that has been announced globally, and we anticipate that it will be implemented. What does that imply? That implies that borrowing levels, refinancing levels stay low, both in emerging economies and otherwise. So what are the numbers that fall out of those assumptions? And this is, lo and behold, what you see for the world in the blue box on the left. A growth decline from 2.9 to minus 4.4 to 5.2. And then you see the distribution across the regions. Let me just say a few seconds with the level, and I'm conscious of time. Minus 4.4 in global growth is absolutely unprecedented. You have not seen negative growth rates in global growth in living history. It's really massive. Even 2.8% that we came in from 2019 is very, very low. On a global scale, we don't speak of a recession when you have growth at zero. Recessions are if growth falls around between 2 to 3%. So we entered into sort of like a fairly weak situation. Why was it so low? By the way, in 2019, Latin America didn't do very well. Also, Europe wasn't doing very well. Okay, so how does it fall out across the regions? You want to just compare the United States, which is bouncing back quite healthily in 2021, but it's not a makeup for the minus 4.3, right? So that's what we mean with a partial recovery. Euro area had a deep recession. Italy, remember Spain, they locked down completely for a period of time. Yes, the bounce back is higher, but they're still not doing well. What stands out quite clearly is emerging and developing Asia, very mild actually recession here and large bounce back. While take China out and things look less favorable. If you take out China, we'll see that in a second, you have a quite solid recession also this year in emerging and developing Asia. So we need to sort of like take that variation into account. Again, so like the big ship that I was talking about, it's driven by the assumption that we're going to have some persistence into 2021 of social distancing. And we have some stimulus that will continue that will help that financial conditions don't worsen. So this is actually sort of a fairly important assumption also, that financial conditions will not worsen. I will not go through this except for pointing out that in this, and you can have these presentations afterwards, that here is the number of emerging and market developing economies, excluding China, where you will see that with China, things look very moderate, but it's minus 5.7 if you exclude China from the emerging economies, because lockdown is costly and very, very costly, even in more labor-intensive areas. So these will be the regional cabins, the individual cabins, how they move. Very sort of common pattern. No point in going through those, but I'll share those if you're interested. So now we care mostly about it. So what does this baseline outlook look like if we take and modify the assumptions? And we've done so in two ways. On the upside, you could imagine that fiscal measures are a bit stronger, that there is some technological boost that you get. We're all online, we're all doing things efficiently. We can actually meet and meet our goals without having to meet physically, and that costs less. And there may be a better therapies, meaning a vaccine out there. So that's the upside scenario. The downside is these muddling along, these outbreaks that continue to come back, spillovers that then go through external demand that sort of pound on top of already weak demand domestically. There is no policy support that can be sustained because it becomes too expensive to refinance. And because why? Because financial conditions, the interest rates, the turnover funding is no longer, the rollover funding is no longer available, and that's the downside. So what does the world look in those two scenarios, upside and downside? So these are, you'll find those in our publication scenarios. What would the world look like if it goes in the one, the upside or the downside? What you have here is the world GDP change. Again, sort of like if you look at the downside, you can have another 3% cumulative decline in growth. So this is all cumulatively. So in GDP growth rates, you would have another 0.5% less in this year, and then another 3% less next year. So we are not that far away from a very, very dire outcome if these downside scenario assumptions would materialize. Okay, how would it spread between advanced economies and emerging economies? Well, pretty evenly. You can see that, and what are sort of the longer term implications? This is sort of like captured here by the debt implications. You can see that will be quite dramatic. So this is worthwhile maybe in a discussion to go back to. What do the assumptions, how do they apply, and so on. But I think that's gives you sort of a flavor of where we could be. Just quickly on the upside, while even things go better, they don't look dramatically better, right, in the first few years. So in 2020, not much. In 21, you may have the global economy grow 0.5% better, and then maybe 1% better than what we assumed. So the risk is on the downside. Okay, last few minutes. What is the implication then of this event for the longer term? And here's one slide I like quite a bit, is where do we end up with our output? So if now 2019 was 100, and we would have been without the COVID, and we are with our forecast, how much less do we end up? And we end up with, in 5 years, a 5% lower level. And that's quite substantial. Where does it come from? It comes from scarring. So the longer people are unemployed, the more skills they lose. The higher the debt burden is, Eventually, you will have to have higher borrowing costs, less investment, and both that investment in skills, in human skills and physical skills, will suppress activity. There is a lot of additional effects that can materialize, especially in advanced economies. There's been already the secular decline discussion before. We went into it, so that comes on top of it. But that's sort of like roughly gives you a sense of where we would be going. What does it mean for living standards? Very dramatic declines relative to what we were expecting, especially in emerging economies and in low income. So this is the per capita, so the per person GDP cumulative growth. And this is what we would have expected, but 20% over 5 years higher. And now we're sort of like getting only 2/3 of that in per capita growth. That leaves a lot of marginalized groups close to the poverty level. So that's a secondary impact, and that effect is really the risks on the downside can make this much worse if that scenario materializes. That's why you'll see in our forecast also as a risk factor social unrest, because that is sort of one of the implications. Finally, what's the other longer term implications? We'll talk about this challenges to public debt sustainability. The share of countries that was able to finance debt out of its, or to pay back interest on its debt out of its regular budget at low shares is declining, and those that are sort of burdened with that are increasing despite low interest rates, just a level effect. We are considering an outlook sort of like on rating downgrades is fairly high. The number of countries that have a negative outlook has increased. All right. If there's a public sector concern, private sector corporate debt and household debt is high. Phakawa will talk about this, and that's his part of the presentation. And I conclude just with the last slide on, so what can you do about it? Relative to previous and other crises, there is really a role for multilateral cooperation, especially on the health and the financial support for constrained countries. It's a common shock worldwide. So you would see that or should consider that much more now than in the past. And then the national level policies, I think you've heard many of those recommendations. I will not go through them, but basically help support the crisis from escalating, support lives, and then move at protecting livelihoods in a very sort of like clever and targeted way, because the constraints are so tight. This is it. I'm going back and let our moderator continue.
Thank you so much, Stephan. I mean, it's a remarkable challenge to do a tour de force of the global outlook and risks in the time you've done, but I think it's been great, and thanks for offering to share the slides. I think our students will very much appreciate that. Just a couple of points. Well, first, to kind of, I'd like to remind participants to submit questions as they occur in their minds, and so I can kind of start curating the questions. So please, participants, submit your questions. Secondly, I just wanted to kind of reiterate something that Stephan said. The global outlook, according to the latest WIO, is an expectation of a contraction of 4.4%. And just to remind people that during the global financial crisis, which was up until now one of the worst, in living memory, global output was still roughly around zero, so it barely turned negative. So that is the scale of what we're talking about. And I guess the third point is that kind of to reiterate. One is you're saying that there's going to be a decline in overall output relative to, let's say, the pre-COVID path, and that in Asian countries was around 5% of GDP. Is that correct, cumulatively? So it's the integration under the curve type thing.
Yeah.
And globally, is it of a similar order, I guess, is one question.
I think it is. I think it's a little less. No, actually, it's a little. It's around the same level, because in
Right.
Asia, it depends on whether you have China in there or not. And,
so the way to think about that is we've basically foregone something like 5+% of global output because of the pandemic. That's roughly, my calculations, was more than the size of the US economy.
Yeah.
That's pretty significant.
Over 5 years, that's right.
So Stephan, I mean, I want to turn it over to Phakawa, but I thought maybe I can just throw a couple of questions at you. Things have changed somewhat since the very recent publication of the World Economic Outlook during the annual meetings. And I can think of two, I guess, big issues. One is, of course, the US election. So, any preliminary thoughts on what the US elections, might mean for your baseline and your and risks. And two would be, of course, we've just heard yesterday that the possibility of this Pfizer vaccine, which seems to be, very effective, could be, distributed by the first quarter. So, any implications of those two significant developments in terms of what it means for your outlook?
Okay, I'm going to go out on a limb here. We don't have any official statement publications on that, and I think that's fair enough on the US to shouldn't be expected to know. I think to some extent things will not change that dramatically because we don't have a change in administration in place or any change confirmed for a while. But so what could be the difference that matters? And I think there are like three things to consider. The one is the fiscal stimulus that has not been renewed in the US. The second one is the dynamics of the pandemic in the US, as well as finally sort of like a clarity about how strong the mandate is of a new government. So these are three things that would matter. On the fiscal stimulus, here our expectation has been prior to the elections that regardless, was it our managing director on October 15, for example, said, no doubt that fiscal stimulus in the US is coming because it's needed. And I think that's probably a statement that she would repeat after the elections again. So I think we would assume that, and that's baked into our forecast. So that part is likely to sort of be in there. We don't expect it to be different. On the momentum, well, you can't change a momentum of a disease so quickly. If you want to change it, you would have sort of a month or two to have very stringent measures. So till January, we don't know what's going to happen, but we assume that it's going to be similar to what happened to the past. That would be my guess. So maybe not such a large impact there either. And on the third part about financial conditions and other conditions, they are likely sort of to be not affected that much either. About the vaccine, well, you heard me in the assumptions, there was a gradual effect of a vaccine and discovery built into our forecast. The big news, in my view, is about the degree of effectiveness, but I don't think the timeline has changed in how fast it could be distributed. So I haven't heard anything like, oh, we can do it now in 3 months as opposed to 6 and 9. I think that's going to be the same. So again, sort of like I wouldn't think that there will be wide swings in the forecast, but I also like to not be quoted on it. It's just sort of like trying to interpret how you would sort of like fiddle around with the assumptions if you had information.
Well, that's very useful. Of course, it's difficult to make that call at this point. Now, well, thank you, Stephan, and hopefully we'll have lots of questions coming in, so I'll come back to you. But in the meantime, I'd like to hand over to Phakawa.
So, good morning. Can you hear me?
Yeah.
Okay, great. So, I mean, it's my pleasure to be here to discuss about, the IMF view on global financial stability issue, and my presentation would be based on our latest global financial stability report that was issued jointly with the World Economic Outlook report that Stephan just discussed. So the theme of our global financial stability report this time is a bridge to recovery. And the reason is that the pandemic has triggered the most severe economic contraction in the century, right? But the global financial stability remained contained. And this is largely due to unprecedented policy support, which has kept core funding market functioning, maintained the flow of credit, and avoided the adverse macro financial feedback loop that we observed during the global financial crisis. However, there is no free lunch here. So if we look at the financial vulnerabilities, they have been rising. Right? So if we look in the real economy and the financial market, they become disconnected. Right? The real economy has not been doing so well. Why? If we look at the stock market, share prices continue to rise significantly. Right? If we look at the global financial condition, they have been quite accommodative, and this allows firms to borrow more to help them bridge financing need. But this also makes firms to become more indebted, more leveraged, right? And this may increase their insolvency risk in the future. For the banking sectors, right, the regulators have encouraged banks to lend more, right, to support the economy during the crisis. But this has depleted existing banks' buffers, right? And we know that going forward, there will be NPLs given a significant economic contraction, right? So banks will be in a weaker position to manage problem loans in the future. So now let me discuss about overall picture of global financial conditions and credit flows, right? So if we look here, the global financial conditions have continued to ease and remain accommodative across many countries, right? So if we look at the main driver are the continued decline in the risk-free interest rate and also the recovery in risky assets. Right? For emerging market, the resumption of capital flows has helped reduce external financing costs, and this in turn contribute to easing financial conditions in this country. If you look at the flow of credit in major economies, bond markets have reopened for a broad range of issuers across advanced market and many emerging markets. Banks continue to lend, especially to non-financial firms. And this has been supported by the drawdown of credit lines, and this is particularly the US phenomenon, and also has been supported by public liquidity support scheme, right, which is a kind of combination of public credit guarantees and central bank term funding. For many emerging markets, right, and to some extent other advanced countries as well, repayment moratorium also effectively roll over debt, and this help maintain the flow of credit to the real economy. We look at capital flows to emerging markets. Aggregate portfolio flows have recovered from March. supported by easing global financial conditions. However, if we look at the risk, right, the outlook of capital flows remain challenging in emerging markets. Right, so for next year, right, there's still a probability of 25% of capital outflows of emerging markets. And if this happens, this will tighten financial conditions in this economy, and then we will have some adverse impact on the real economy. But if we look at the local financial stress, which is based on local government bond market, and also foreign and also currency markets in the country. Right, the financial stress in this emerging market has come down. I mean, one thing that I would like to highlight is that the central bank asset purchase program has been helpful. Right? So country that where central bank have buy some asset, this help reduce local financial stress much more than country that do not have this program. So if we think about, I mean, how global financial conditions may affect the growth outlook, right? Stephan has discussed, show you about, I mean, how the fund view about the growth this year and the growth projection next year, right? Even we think that growth for 2021 will be positive if one take into account of global financial conditions and financial vulnerabilities. Our analysis based can show that there's still a 5% likelihood that the world could fall into contraction. So this is not a trivial tail risk to economic activity. So let me discuss about some key vulnerabilities in the global financial system. So the first one is the disconnection between the real economy and financial market. Right? So this chart shows that the S&P 500, which is the major stock index in the US, right, has a recovery. But if we look at the composition, right, or the driver, we would see that the earnings, right, continue to drag down the share price. But the recovery has been supported by the risk-free rate and also the compression of the equity risk premium, right, which have been driven by unprecedented policy support. Right? But if we look at the recovery of share price, we actually also observe a wide range of differentiation across countries and across sectors. Right? The U.S. stock market more recently has been driven by the tech stock. Right? So if we look at the top 5 U.S. stock, which are tech firms like Facebook, Google, Amazon, they are doing very well, right? And these tech firms are actually doing very well during this pandemic, right? And if we look to China, is also have a similar picture, and the rebound has also been driven by tech company and that doing more on consumer in China. Right? On the other hand, financial firms and firms in the energy sector have been underperforming. Right? We have a similar picture in the fixed income market. right? If we look at the dynamic of U.S. investment grade corporate bond yields, right? They have the bond yield have declined, right? And basically the decline has been driven by the risk-free rate and also other policy support that help compress the risk premium. If we look at the fundamentals, right, look at the firm value, look at the firm leverage, this would suggest that the bond yields should go up. Right? So this is kind of the example of a disconnection between the real economy and the financial market. Why do we care about this, right? Because the disconnection to a large extent, right, has been induced by policy support. Right? So if there is some, if markets, right, we assess the scope of policy support, right? Stephan just talked about the U.S. election, right, which may affect, right, the potential outcome of fiscal stimulus in the U.S., right? And this has a significant impact on financial markets that we have been observed in the past week. So if we look at vulnerabilities overall, right, we have seen that the vulnerabilities in the non-financial corporate sector and also the sovereign has increased. Right? If we look at the asset management sector, vulnerability has been elevated even before this pandemic, and the vulnerabilities in asset manager sector, right, was part of the reason that why we experienced a very significant financial stress in March this year. So if we look at the corporate sector, right, the pandemic has hit the corporate sector very hard, and this is because of the lockdown measures. Right, at the beginning, liquidity support has helped prevented outright widespread bankruptcies. Right, but as the crisis continue, right, these corporate liquidity pressures may morph into insolvencies, right, especially if the recovery is delayed. Right, so going forward, right, countries will have to deal with like zombie firms or debt overhang, which can cause resource misallocation and undermine productivity going forward. So if we look at the corporate sector globally, right, aggregate corporate debt has increased and is at the highest level in several countries, right? And basically the rating agencies, right, I mean, based on the weaker corporate balance sheet, now they expect corporate default to increase, although their forecast has a wide range, right? And this is also subject to a large degree of uncertainty that we are facing. In this crisis, SMEs are hit harder than larger firms, right, that continue to have access to capital markets. So SMEs, so this chart basically show the share of firms that will not be able to generate enough earnings to cover interest expense. Right? And basically, we have seen this share of our weak firm increase across all sectors. Right, so and this highlight, right, that that going forward, corporate insolvencies could become quite a critical issue. Other area of vulnerabilities in the corporate sector in the commercial real estate segment, right? As given the lockdown, given social distancing, commercial real estate, especially in the hotel or retail segments, they are not doing very well. And this could be another major source of vulnerabilities. So turning from the corporate sector, right, which are the borrower, to banks, which are the lender. Given the losses, insolvency in the corporate sector, the lender will have to deal with these potential losses at some point. Fortunately, right, the banking sector globally entered the crisis with strong capital and liquidity buffers. Right? This allowed us to be in a stronger position, right, compared to the global financial crisis to deal with the economic challenges. But borrower support measures, right, and also regulatory flexibility have supported bank lending so far. However, right, bank will have to deal with NPLs at some point. And given that reduced profitability during the crisis, and also the use of that buffers, right, at the earlier phase of this crisis, right, bank lending capacity could become constrained going forward. So in this global financial stability report, we are also doing a global bank stress testing exercise. Right? This exercise covers about 350 banks in major jurisdictions where financial system is systemically important. So this exercise, unfortunately, we don't have the data to capture China, but I mean, you can think this to capture all other major financial banking system, right? The exercise show that there would be a tail of weak banks that will not have enough capital to meet the minimum capital requirement. At the global level, once we take into account our policy support and banks' response, there could be 220 billion US dollar capital shortfalls in an adverse scenario. Not this is not baseline, this is an adverse scenario in the world outlook that Stephan discussed earlier. Let me skip the emerging market and frontier economy and turn to the discussion of policy priorities. Right? So far, policy support has helped maintain financial stability, right? But this has increased vulnerabilities in multiple sectors. Right? So this chart shows that among the major 29 economies, actually 6 of them are classified to have high vulnerabilities in corporate sector, in sovereign sector, and in banking sector. Right. So this highlights the fact that going forward, policymakers will face quite significant challenges, right? While they try to continue providing support to the economy, they also have to deal with a more limited policy space, right? And also increase vulnerabilities in the financial system. So this is kind of the key policy message from this global financial stability report. Right? The bottom line is, right, in the near term, as the economies reopen, right, continued policy support remain critical. right? Accommodative monetary policy and financial policy, right, will help keep financial condition at an easing level, right? This help maintain credit availability, right, and to some extent provide liquidity and solvency support to firms, right? This help firms to go back and operate, right, once the economy reopens. It's also important that this kind of policy support, right, help transform the economy. Right? We know, I mean, the pandemic, right, seemed to accelerate, right, the transformation of the economy toward digitalization or kind of a green economy, right? And to the extent possible, right, policy measure should also help direct the global economy toward that direction. One important thing is policy maker, right? We also need to think about how to handle solvency problem going forward. Right? So far, policy support target at elevating liquidity pressures, right? But once the economy reopen, liquidity support will have to be withdrawn, right? Because I mean it's not sustainable, and then solvency problem will emerge, and then one should thinking about how to deal with this, right? In the corporate sector and also the banking sector. And once the pandemic passed, right, it's probably a good idea to look at the regulatory framework, right, that to help enhance, right, the resilience in the non-bank financial sector, which have caused significant financial stress in March this year. So let me stop my presentation here. So this is kind of a quick overview of the global financial stability